We want to thank everybody for joining us, and I'm informed that we have our desktop viewing figured out. So we've got our slide presentation. We're excited to get going today. So thanks again to all of you for taking some time to join us today. We really appreciate, and we know how many demands there are in your time. We know how many opportunities there are to find content. But we appreciate that you're here, and I think we have a unique perspective to share with you with our team today. You're going to hear again from Scott Duba, and those of you who have joined us before know that as our Chief Investment Officer, Scott's going to bring a great deal of market understanding and the ability to articulate that to you in a way that will help you out. So we're pleased to have Scott with us here yet again. We're joined by Marilu Morrison, who's got extensive experience both as a portfolio manager, an investment manager, and investment advisor, as well as working within the savings and loan area. And so we think that she's going to have particularly interesting perspective for us today as we talk through the recent banking crisis and address many of the questions that are on your mind. And then finally, we'll have Eric Kraus, a portfolio manager who has extensive experience dealing both with the investment management, the investment analysis part of things, but also in communicating with private wealth investors as well as retirement plan participants. And so we appreciate the practical way in which Eric looks at all those. And then Matthew Eichmann, our retirement practice leader, here to kind of guide us through our discussion. So I think to start off, I just want to highlight for everybody what a challenging news cycle it continues to be for us. And the headlines certainly can confuse any of us. They certainly lead us to believe that things are good or they're bad, and that maybe good news is bad news, or maybe bad news is good news, and we just don't really know, which way is up. But in particular, the headlines have been dominated by the struggles within the banking industry recently. And so we're going to have a lot of conversation about that today, hopefully put you in a place where you feel better informed about what has happened and then what we expect to happen as we move forward. But where we'd like to start things off today is to zoom out a little bit. I'm going to hand it over to Scott and Eric so you can talk through what we've seen in the market so far in the first quarter of the year. Scott, why don't you take it away?
Thank you, Matthew. So if we start by just looking at the equity market year to date, what this slide shows you is the gray bars represent historical annual equity market returns, and the dots on the lower half of the page represent intra-year troughs. And so what you see when you look at this chart all the way on the right is year to date, we're already up 7%, which follows a pretty ugly year last year, as we all know, in which the market was down as much as 25%, but ended the year down 19%. So if you look at the historical patterns, not surprisingly, bad years are often followed by good years. And year to date, we're off to a pretty strong start where the market seems to be at least somewhat following that pattern on a year to date basis. If we flip to the next page, another thing we can draw from this is just how the U.S. has fared globally, the U.S. stock market. For those of you that don't know this, the U.S. market makes up about 60% of the total equity markets, or at least of the MSCI All Country World Index. So it tends to dominate the global capital markets. If you look at the table on the left, what you see is that the U.S. return year to date at around 7.5%, is about the middle of the pack. The European economies tended to do a bit better year to date. Europe, excluding the UK, is up about 12% year to date. And the France and Germany in particular have had pretty strong year-to-date returns after being down last year. And part of that story is a little bit of an easing of an inflationary pressure, commodity pressure environment in Europe, where some of the worst fears about a recession in Europe have proved to be not quite so bad. So year-to-date, the U.S. is doing well. International markets are doing a bit even better than that. Turn it over to bond markets. I'll let Eric cover this one.
Yeah, thanks, Scott. So we have a very similar chart to what you just shared on the equity markets. Only one big difference here, and that's where we look at the annual returns and intra-year declines of the bond index. And we see that last year was a significant outlier, minus 13%. So far this year, it's good to see that while stocks and bonds did trade down together last year, they are trading in unison together this year, and we've seen some recovery there as well. If you'll go to the next slide, Matthew, we can talk through the differences in various types of maturities in bonds. And this has really been a story of the rising ship bringing all time, or the rising tide bringing all ships up together, where we can see right in that middle there, Matthew, if you could highlight for us the year-to-date return. We can see that the return of both short-term treasuries and long-term treasuries are positive, but of course those longer-term treasuries have been more impacted by the decrease in interest rates in the back half of the curve. So we've seen some particularly strong performance in those 30-year bonds. So Scott, I'll turn it back over to you to go through some valuation slides.
Yeah, so if we kind of summarize what this looks like from a portfolio perspective, we look at the 60-40 portfolio a lot because that tends to be where most of our clients sit from a risk perspective. If you look across both the retirement side of our client base as well as wealth management, most people like a moderate to slightly aggressive portfolio that's about 60% equity, 40% bonds. This slide combines a few of those previous slides where the green represents the equity market return in the 60-40 and the gray bar is the bond contribution of that. And again, if you look right year to date, we're up about 6% following a pretty ugly year last year. Again, sort of following that historical trend of reversions after we get these really bad years. So, you know, there was a lot.
Sorry, I was going to say last year we saw a lot of those headlines that talked about the death of the 60-40 portfolio. Those always tend to come about whenever we have those returns when bonds are negative or interest rates are low. So just an interesting dynamic to see that those have sort of rebounded here. I don't know if you have any thoughts on that on a forward-looking basis.
No, I think absolutely. Bonds are not dead, and the year-to-date numbers can show that to some extent. Now, if we put the next one into our valuations, this slide's a little bit busy, but what you can see here is green dots and black dots. Green dots show what these various markets were valued at the end of 2021. If you recall, the equity market, the S&P 500 was at about 4,800 at the end of 2021. And not surprisingly, a lot of these relative value measures on these asset classes would suggest that things were rich versus the previous 25 years. The circle dots below would show you that things have gotten a little bit more reasonably priced. Most of these asset classes are within plus or minus one standard deviation of where they've traded over the past 25 years. On the left half of the bar chart, we can see that developed market equities, excluding the US, treasuries, and emerging market equities actually look a little bit undervalued relative to historicals. And on the right side, we can see that US growth, while less expensive than it was a year ago, is still a little bit more expensive than it's been over the past 25 years. And to those of you that have been following the year-to-date returns, this has largely been driven by US growth, large cap tech. That shouldn't be too surprising that it's still a little bit better than fair value in our opinion. If we flip to the next slide, on the international front, international still tends to trade at a discount to the US, even with the pretty strong year-to-date performance. For context, the current PE, price to earnings ratio for the domestic equity market is about 18 times. So if you pay $18, you'll get about $1 of earnings in US companies. Internationally, excluding the US, you pay about $12.50 for each dollar of earnings. So the international markets still trade at a significant discount to US markets. And that compares even more favorably to the historical averages. Historically, over 20 years, domestic equities traded about 15.5 times PE, and international traded about 13. So the US market still looks a bit expensive relative to history, whereas the international markets still look relatively cheap. If you look at the left side of the page, this shows kind of in percentage terms how cheap on a PE basis international markets look versus the US. And granted, this isn't taking into account forward growth prospects. This is more just a snapshot. But nonetheless, the PE on international companies is about 30% below US companies, which is 2 standard deviations below the historical average. On the right side, we can see that in cash flow terms as well. Dividend yields on internationals tend to be a bit higher. Not surprisingly, because these are stocks that trade at a little bit more of a discount, and they also tend to be more cash flowing. You get about a 1% or 2 standard deviation better dividend yield in international markets as well. If we flip to the next page, we'll lastly touch on fixed income. Obviously, rates are a lot higher than they were over the past 10 years. If you look all the way on the left, U.S. Treasuries are at about 3.8% now versus 1.5% over the past 10 years. That's a big deal. Our economy, a lot of these asset classes have gotten used to having low risk-free rates. Now those risk-free rates are at 3.8%. If you look at those blue triangles, those show what impact those higher rates have had across all these asset classes, whether it's municipals, IG corporates, asset-backed securities, emerging market debt, or U.S. high yield. You're getting a lot higher yield in these asset classes than you were over the past 10 years. In most cases, that's due primarily to the risk-free rate being higher, but in some of these asset classes, particularly IG corporates and others that are higher quality, you're also getting pretty good credit spread compensation for the risk you're taking as well. So we continue to spend a lot of time on the fixed income markets and would remind everyone that you can still earn pretty good risk-adjusted returns in fixed income, even though that really hasn't been there for the better part of the past 10 years. With that, Matthew, I'll turn it back over to you.
Well, yeah, thank you. And I think for both Scott and Eric, we're going to come back to some of the points that you've made and ask you some follow-up questions that really allows us to be even more tangible and practical. I think for a lot of people listening, they're thinking, well, what does this mean to me? And so we'll be able to revisit some of those topics and say, here's what the data shows us through the first 3 months of this year, and here's what this practically means to you. But before we do that, as I mentioned earlier, we really want to talk about this topic that has been first and foremost on people's minds so far this year, and that's the banking crisis. And we're really fortunate to have Mary Lou here with us. You know, she has, before her time as an investment manager and investment advisor and working with CrossVault and Prime Capital, experience as a vice president and an investment manager with First Federal Savings and Loan. So Mary Lou, I imagine that as you started to see these headlines and all these concerns and people worried about run on the bank, et cetera, it probably brought back some memories for you. And I think it'd be really helpful for you just to speak freely on how this banking crisis compares and contrasts with banking crises of the past.
Great. Well, thanks for having me. Yes, it's been actually 40 years almost to the day, 1983, when I started in the savings and loan business, and we had a lot of the same cross currents going on. You may remember the high inflation of the late 70s and Paul Volcker coming in and raising rates, trying to shut down that inflation. And we're seeing the exact same situation right now in the current banking crisis. Fortunately, it seems like the immediate crisis has been contained, as evidenced by borrowings from the Fed discount window going down. Now, a lot of that borrowing has moved to their new facility called the Bank Term Funding Program, and I'll touch on that in a moment. But they also quickly resolved Silicon Valley Bank and Signature, got buyers for the deposits and the assets, and they're working on that. But I would say this is going to be a little more similar to that savings and loan crisis, where it's a slow-moving crisis. There's going to be a lot of margin pressures on, especially the smaller community banks. As interest rates have gone up, they're having to pay more and more to keep their deposits. There's been a big flight out of the banks because of concerns over safety and the $250,000 FDIC limit. But I think what we're going to see over time is it will actually be positive for our economy, because capital will come out of weak holders and go into stronger holders, and we'll probably see more consolidation in the banking industry. The Fed, like I said, acted decisively, and the Sunday after Silicon Valley Bank went under, announced this new facility where banks can collateralize their borrowings with the Fed for up to a year, and they get to do it at par, which the rest of us don't get to do that, but the banking industry will. And so part of Silicon Valley's problem was they had to sell their long-term bonds at a big loss due to this quick increase in interest rates. And now banks, instead of having to sell that at a loss to cover their deposit outflows, they can go to the Fed, pledge their long-term securities, and not take the write-down. And so I think what that's going to do is buy time for these smaller banks to finally adjust to what's going on in interest rates.
So you mentioned that I think you said the immediate crisis has been contained. So I think it's natural for people to wonder, so is it over? How would you respond to that question?
I don't think it's over, because we're going to still have a lot of earnings problems in these banks due to them having to, they basically had paying zero interest on their deposits for years and years and years. Scott referenced that in the fixed income chart he showed a couple of slides back, that we're in a much different interest rate environment. And it's going to take them time to bring depositors back to their banks. There's probably going to be some stress on their loans. We're already seeing the shutting down some commercial and industrial loans and commercial real estate loans. So I think it's going to be a multi-year process, not probably a decade long like the savings and loan industry. Things just move faster these days, but I would say at least several years. But again, we're calling this a banking crisis, not a financial crisis. I think it's contained to this, for now, this, the smaller community bank sector.
So if we do confine it to a banking crisis, it's natural then for people to wonder, should they be worried then about the cash that they have in banks? And so how do we help people navigate that important question?
Well, I think it's the same thing we've been, advising clients for the last several months, is you shouldn't have more than 250 in any institution. I mean, that's the FDIC limit, and naturally there's already been pressure on these banks before this crisis because they weren't paying enough, and money was just naturally flowing out of these low-paying deposits into higher money market funds. I mean, the 3-month T-bill is 5% today, which is the risk-free rate. And so I would say it's just a continuation of what we have been saying is, try to get as high a rate as you can with as little risk, and monitor your deposit limits at banks.
Eric, bringing together two concepts really quickly. She just mentioned that rate being above 5%. What was our expected 60-40 portfolio forward-looking return, 6 months ago?
Well, let's back up 18 months, because 18 months ago, that expected return on a 60-40 portfolio was only 4 to 5% over the next 10 years, which was historically painful, I think, for investors to try to digest that into their financial plan of an expected return on a diversified allocation that just really wasn't up to standard or up to par. And now you can get that, as Mary Lou mentioned, risk-free for 90 days. There's some banks that are still offering some CDs out in that 12-month range. We do have that yield curve that's inverted, however, though, so we know that these rates won't be around forever, but that's probably a good topic for another discussion. But certainly, it's a great time to take advantage of those rates and not accept those very low interest rates that banks are still paying on checking and savings deposits.
So we hear there's much more upside now to that money that you have in the banks. I think we refer to that as a risk-free rate. But the takeaway from Mary Lou's comments, of course, is that FDIC insurance only applies up to the $250,000 level, right? So people should be mindful of that. Maybe a related question then, Mary Lou, is we think banks, are they going to continue to lend in this current environment, or what, if any, changes might we see in that respect?
Well, we're already seeing some loans running off as they're having to downsize their balance sheets due to the outflow of deposits. And that's, as I mentioned, from the Federal Reserve release last week, it was in the commercial and then also commercial real estate. And so that's something I think we need to keep, close eye on. I think it's going to happen, what normally happens is when the banks become more and more risk averse with zero interest rates, they were taking risks left and right, and now they're going to have to really focus. And the best depositors, I mean, best borrowers who probably don't need the money can still get loans. And the marginal borrowers will not be able to get loans. And we're already seeing that anecdotally just in the journal today. You know, small businesses are having more trouble getting loans. The NFIB Small Business Optimism Index came out, and 9% of these small business owners said that financing was harder to get than it was 3 months ago. And they're the big job creators. So I think it's something we've got to be concerned about.
And Scott, we've flashed up here on the screen a flow chart, if you will, demonstrating how banks make money. Are there any elements of that you'd like to talk through as they apply to our current conversation?
Yeah, I think Mary Lou touched on our general concern about regional bank profitability. And I think a point to make about this banking crisis versus prior banking crises is that this, at least for now, is largely on the left side of this page, not so much on the right. The left side of the page is the liabilities. That's how banks get cash to lend out into the stuff on the right side. And the issue with margin pressure is that line, that arrow right in the middle, the cost of interest paid to depositors. If you looked at what the average rate was that banks were paying on checking and savings accounts over the past 5 years, it was nothing, or it was a quarter point. One thing that this banking crisis has brought front and center for retail clients, especially and especially corporate clients, is the paltry returns that they're getting on these excess uninsured deposits in banks. Like, you wouldn't fault a CFO for maybe not even being aware that he or she could get 3 to 4% risk-free in the money market on the millions of dollars that he or she had at Silicon Valley Bank, because it was zero. Like, money markets were very low over the past 10 years. Whereas now, as these monies start to flow out of bank accounts, these uninsured deposits into the money markets, that's meaning the banks have to raise what they pay the depositors. And so that's going to be a huge issue, because that's the bulk of the funding, and it's getting more expensive.
Yeah, and I'd also just point out too, on this chart, on the right-hand side, I touched on it. Banks are not going to be forced to sell their longer-term securities at loss due to this new Fed funding facility. So the Fed is buying time for the entire financial system to adjust to these higher rates.
And you mentioned earlier too that we had maybe some fortuitous timing, and that the Fed was able to act a little bit over the weekend when this first broke and kind of got the word out there. I've wondered many times if we would have seen any dramatically different long-term impacts if the news had broken on a Monday and there wasn't that opportunity to absorb the information. Frankly, the inability to act for many, over the course. So to that extent, the calendar may have protected some people from themselves.
I've been wondering, I have no proof of this and I haven't talked to anyone, but I think they must have had this plan in their back pocket, along with having, they have CEOs on tap that they flew in immediately to Silicon Valley Bank and Signature Bank to start taking over and shutting down. So it wouldn't surprise me if this was kind of a recovery plan they already had in place.
Well, and I think it's encouraging for us to hear that to a degree, right? Because as frustrating as the political system in our country may be, without regard to your political affiliation or your party affiliation, it's good to know that we still have adults in charge of some areas of things that impact our people. And so, so I think that, that may be encouraging. So, okay, so here's the question that I would have as a listener here. Okay, we've seen a bunch of charts and graphs, and there's a fair amount of complicated information here, but at its barest essence, if somebody walks away from our conversation today and wanted to communicate to somebody else, hey, these are really the main implications of that banking crisis, what would those be? And I know each of you have some prepared remarks, and so I'll let one of you jump in and kind of start with item 1 here.
Sure, I'll take the first one. Tighter credit markets and slower growth. Matthew, if you flip back to bank balance sheet page. When banks get under pressure, they tend to get defensive on the right side of the balance sheet. They don't want to take as much risk. And if you look at the top of this chart, it's cash, and at the bottom, it's loans. So if you're a banker that's worried that you're going to have depositors leaving, you're going to need more cash, and you're going to want less cash tied up in loans. So what that means from a practical standpoint is that marginal next borrower that walks into the branch on a Tuesday might not get his loan that he would have gotten 6 months ago. And so when you think about that on a more national scale, that marginally harder to get financing, that next guy that doesn't get the loan to build a plant or hire people, like that's going to slow down growth. And to some extent, you could see that as the private banking sector doing some of the Fed's job for them. And I think that probably leads us into our second point, which maybe Eric can cover.
Yeah, I think that's right. I mean, ultimately what the Federal Reserve was attempting to do was tighten monetary policy or destroy demand. So to bring back some equilibrium. And to Scott's point, this crisis, for better or for worse, has sort of done some of the work for them. It's caused a slowdown, or at least a forecasted slowdown in economic activity, which is what the recipe is for loosening back up the labor markets, perhaps getting inflation under control. So that lower terminal Fed funds rate, we saw very quickly the expectations going from perhaps a 50 basis point rate hike in March, and then another 50 basis point rate hike in May, trend to, will they even raise rates in the midst of a crisis like this? And I think they tried to hit it down the middle with a 25 basis point rate hike in March. Now the jury's still out. Will we get another 25 basis points in May? And some of that may depend on the data that we get tomorrow and Wednesday with the latest inflation reports. But certainly a lower terminal rate. And again, I think we have a slide on this later to illustrate the market's expectations of perhaps that rate being cut a bit sooner.
And then how about this third item relating to regional banks and their profits being under pressure?
Well, I think we already pretty, talked about that when we were looking at how banks make money. One thing I would say that could be offsetting some of the higher deposit rates is the 10 years already dropped from 4.25 to 3.40 today, and that will take some pressure off their securities portfolios. And I think that also speaks to what Eric was talking about, is the expectation is that this crisis may have pulled, has already been impacting inflation, and the Fed won't have to be as aggressive going forward.
Okay. We do have some concerns on those regional banks, though, Matthew. I think it's hard to overstate this, that regional banks are so critical to small businesses across our country. And all those assets that left Silicon Valley Bank went to JP Morgan and Bank of America, the too big to fail banks. Those too big to fail banks don't underwrite a new 10-person company in Kansas. So it's really critical that these banks maintain some form of profitability and ability to lend, because Mary Lou mentioned those small businesses are the job generators. So it is. I think it does have us maybe on heightened recession watch, if you will, or maybe lower GDP expectations, and we really need some recovery there and some continued strength to feel better about that.
And then Scott, you touched already on item 4, but maybe you can revisit the comments there about the opportunities and the risks within cash balances.
Yeah, I think it's pretty straightforward. If you have more than 250K at an individual bank, you should take a hard look at other alternatives that are very liquid, very low risk, and offer quite a bit higher yields. Money market funds offer 3% plus. That's kind of an easy win for corporate treasurers to diversify their cash balances and earn a little bit of yield on a very safe asset class.
Right. All right. So we look back at the first quarter of this year. We look back more recently into these banking crisis developments. Now let's start to look ahead just a little bit and put you in a position to bring out your crystal ball on a few things. But I think the first question a lot of people have, as we've seen this steep spike in interest rates, is the Fed done? Is the Fed finished with raising rates? And I think we'd be interested in any comments you'd have.
I'll go first. I mean, I don't think they are. I think we'll get at least one more 25 basis point raise. And then from there, I would think we'd probably get another one at least. If you look at the employment data we saw earlier or last week, the unemployment rate's still at 3.5%. Job losses are very low. There's still a lot of strength in the economy. If there's one thing that the Fed has said loud and clear, it's that they are adamant, at least for now, about getting inflation down to 2%. So I think the market is getting a little bit sanguine about rates going down in the back half of the year, when we really haven't seen the flow through in the real economies to suggest that's necessary yet. So I do not have a crystal ball, but I would think we get at least one or two more.
Yeah. Does anybody want to agree or disagree with Scott as you look forward on that?
I would tend to agree on at least one more in May, just based on what all the Fed governors are saying and what the futures rates are predicting on, one more hike. And, there is this huge lag between when they start raising rates and when we start seeing it in the real economy. And the only reason I'm disagreeing with Scott on maybe them not doing another one is if we start getting some better inflation data, because there's been a lot of bubbles already taken out of the market between the SPACs, the IPOs, the blow up in crypto, housing's rolled over. Well, the entire economy seems to be doing well. There's been pockets that have already been in a recession, I feel.
Well, so Eric, I think that naturally takes us to the next question, right? The issue that we will talk about today that probably impacted the most number of people who are listening today is inflation. It directly hits their checking accounts, their pockets, if you will. So has inflation peaked?
Well, you gave me kind of an easy question to say a direct yes. I think it has peaked because I think it peaked last fall when we saw those numbers over 8%. The much tougher question is when will it get back to 2%, is it going to spike back up before it gets there? So much like when inflation was on the rise, there were a few hitches along the way where perhaps we had a false sense of security, or maybe things were going to stop getting worse and then they didn't. And it's very possible that we'll have a reasonably good inflation number tomorrow, but then it could be worse again when we get the April reading, 4 to 6 weeks from now. So I do think that inflation largely has peaked, particularly in the goods sector. We get some anecdotal evidence, so even from some of our clients in the food industry, that suggests that there's still plenty of pain to be exerted there. But the most encouraging thing to me is, even though the labor market is very resilient and the unemployment numbers would reflect that, we've started to see some increased labor force participation numbers. And that's really what we've all been looking for, to help bring that back into equilibrium. No one wants the unemployment rate to jump to 5% to solve inflation. What people want to have happen is that gap between the number of jobs that are available and those seeking employment to come back down into a normal and supply and demand environment, which brings wage growth back into a normal historical level as well. And whether it's due to stimulus money running out, consumer balance sheets getting weaker, or just the inflation itself causing people to need additional income, that labor force participation is starting to head in the right direction. And I think that will be the biggest driver of improvement for us here, but that's going to take some time. So I do think inflation's peaked. I don't think we're going to 2% at the end of the year. We may get stuck in that 4 to 5% range for a while while we continue to chop through this.
Eric, you mentioned that we may see a good inflation number tomorrow. What does good mean in that regard?
Good means lower, right? And there's all sorts of ways to slice and dice that. And you can talk about the headline number, which includes everything. And then if you want to try to make things look better, you could exclude food and energy, but maybe sometimes that actually makes things look worse. But again, what the Fed has sort of focused in on is what we would call the service side of things versus goods. And the service side of the economy is much more driven by labor costs, just by the nature of providing services, right? That's your biggest input cost. So I think a lower number. The problem is if we get, let's call it a 0.3% month over month increase. If you annualize that, that's 3.6%. That's not bad. But what happens if it spikes back up to 0.5% next month? Annualize that, and all of a sudden we're back into an uncomfortable annual rate of inflation, which everyone's looking for. But there are some positive things to consider. Last year, if you think about fuel prices, gas prices being well north of $5 per gallon. Well, this year it's a lot lower than that, and that's not inflation, that's deflation. So there are some sectors. Gosh, I hope the price of eggs is going down. Hopefully we get some deflation in eggs. But there are some persistent portions of this that we just need to keep an eye on, and to Scott's point, not get too sanguine that things are just going to automatically drop back down to normal levels.
So, this is maybe a mix between an academic question and a practical question. What do you think in terms of whether there will be a recession, and if so, or if not, how will that impact or not impact people? Who wants to take that one first?
I'll take it. I'd say yes, eventually. Horizon. So I think we've been talking about a recession for 12, 18 months. I mean, the probability of recession per the experts has been 2 out of 3 for the better part of 6 months. So Eric and I have talked about this earlier in the week. It feels like we've been waiting for this recession for 12 months, and it hasn't come yet. So I would think at some point, yes, we will have a contraction in GDP. The bigger question is that priced into the markets or not? And right now, we think the markets look pretty fair. Valuations are not cheap on the equity side, but they're not nearly as expensive as they were 12 months ago. And what we're looking at now is we'll learn a lot from the earnings forecasts of these companies in the next 3 weeks. We're coming into Q1 earnings season where we're going to see earnings down probably anywhere between 5 and 10% overall for the S&P 500. And what these management teams tell us, what they project for the back half of the year, that'll give us a real good read on the real underlying strength of the corporate economy. And we'll see. There's still a lot of pressure on the economy on the one side, but there's still a lot of positive inertia. I mean, again, pointing to those unemployment numbers, pretty good GDP growth we think comes out of Q1. Yeah, things are pretty balanced. Eventually we'll have a recession, but we haven't seen it yet.
I like Mary Lou's analysis of the rolling recession.
I was going to say, I think a lot is going to depend on if you develop a real credit crunch for the smaller borrowers, for small business. And that's just something, it's hard to predict at this point. We'll just have to watch.
And Eric, can you pick up on her last point there? And, I think it's almost repeating what she said, but help everybody understand the trickle-down impact on our entire economy, all the way down to the individual level, when those smaller businesses can't get access to credit. What does that really mean, and how does that impact us?
Well, I mean, ultimately it means they can't invest in growth. They can't take on new projects, right? So the number one, the hurdle for taking on a new project is a lot higher, because Scott mentioned this earlier. If you could borrow money at next to nothing, you could do a lot of projects that would make next to nothing, and it was a good decision to do that. But as that hurdle rate increases, your cost of borrowing goes up. Number one, people are going to be more hesitant to take on. We see these forecasts of 65% chance of a recession. And that's pretty high, even by economist standards. So why would you want to take on or launch a new product line or do something that's difficult in this environment? So even if you could, though, if the banks don't have the money to lend, or they can't lend it, or their standards for lending it are so high that they just aren't willing to extend those opportunities to the small business, ultimately that slows economic growth, it slows employment, and it slows just the velocity of money changing hands, which is a big driver of overall GDP.
Oh, thank you. So yeah, yesterday's Wall Street Journal, there was a front page article entitled "Investors View Corporate Earnings Season as Next Test for Stocks." Our own Scott Duba was quoted in that article, again on the front page of the Wall Street Journal yesterday. And Scott, I wonder if you want to elaborate maybe on the points you made within that article, and then as that relates to the question in front of us here, is the bear market over?
Yeah, what I was talking about in the article was a lot of the content we've covered today, which is what we're looking for in this earnings season is evidence as to how much this credit crunch is going to impact the economy. And to Eric's point, the cost of financing is higher, even if you can get the loan. So there's one thing to be approved for credit. There's another thing of whether or not it makes sense to take the loan. You may have been able to finance a project at 4 or 5% a year or 2 years ago. Now, even if you can get it, it's 8 or 9%. And so we're very eager to see how this is going to impact the earnings in these companies. For context, this is the fastest rate rise we've had in over 40 years. You know, it's one thing to go from 0 to 5% over a number of years slowly, but with some of these, 50 bip raises all kind of stacked on top of each other, this is a significant change in how businesses operate, how consumers operate, and how money flows through the system. So what we're looking for is really more evidence of kind of the impacts of all of this, the banking crisis, the higher rates, everything. And I would say whether or not the bear market is over, somewhat of an academic question if you're one of our investors that thinks in 10 to 15 year horizons. History would suggest that the second year after a bear market, which would be the next 18 months, is usually pretty good. So it's never an easy call to say we're not going to see lower markets. But history would suggest that if you stay invested, invest in a good diversified portfolio, you'll do pretty well over time.
Yeah. Eric and Mary Lou, anything you want to add to that?
No, that was a great summary, Scott.
Eric, I've got one in front of you here that I know you speak to from time to time, where we think about the degree to which consumer confidence may give us a sense for what's up ahead. You want to speak to that?
Yeah, I think this just kind of goes along with the concept of not following the herd. Following the herd or following the fear that's perhaps mongered on TV to gain viewership will lead you to sell low and buy high, because you would want to buy when the news is fantastic and nothing could be wrong with the economy. And certainly you wouldn't want to invest when the market's already down 20% and the news is just going to get worse. And that's what this chart reflects as we look back. And maybe we're past the trough, if you will, the sentiment trough that occurred last year. But the statistic, I think, is the same, and the chart's still positioned very similarly. And that historically, when we look at the sentiment peaks, when consumers think everything's going great, that's been a very poor time to invest and has averaged only a 3.5% 12-month return on the S&P 500. Whereas when it doesn't feel good as investors or as consumers, historically that's been the Warren Buffett time to buy, right? That's the time to invest. And just to kind of follow up on that point, is the bear market over? Good news, it isn't. You haven't missed it yet, because the market's still 15% off its all-time highs and worse than that in some sectors. So if you're a long-term investor and you can accept that the first move might be 10% down, but the long-term move is substantially higher from here, you're getting still, in my opinion, pretty attractive relative valuations. Not cheap, but fair. And fair valuations over the long term have been a very good place to be for investors in equities.
So Eric just told us that it's good news that we're still 15% off market highs. And I think, with that in mind, the last question that we want to address is one I'm sure many of you have, and that's, what should I do now? And, we looked at this earlier, the idea that it's not uncommon for us to have significant intra-year drops. In fact, it's very common. It happens more often than not, but if you play the long game, people tend to do better. And as you think about the fool's errand that is trying to time the market, this chart does a really nice job of demonstrating just how hard, if not impossible, that is. So go back 20 years and put $10,000 into the S&P 500, and let's just say you let it ride. And if you let it ride for that 20-year period, you can see all the way here on the left that you'd have around $64,000 sitting in that account. But what if over the course of 20 years, so between 4,800 and 5,000 trading days, you missed only the 10 best days in the market? If you missed only the 10 best days over that entire time, what you would have in your account is more than cut in half. You'd be sitting at merely $29,000. So doesn't this really highlight just how hard it is to time the market? In fact, if you look at that text box in the middle of the chart, recognizing that very frequently the very good days come shortly after the very bad days. And so with all that in mind, remaining true to your plan, retaining exposure to the market, staying invested, continue to save, those are all critical steps for each and every one of us to take. And this is a really good time to revisit your strategy, to have a conversation with the person or the people who help you with that, and recognize that it's important to always reevaluate. Make sure the way that you are invested still holds true to what your goals and your expectations are as you move forward. Call your advisor. Say, I want to have a meeting. I want to have a conversation. I just want to make sure that when we made that decision in the past, not only how has it worked or not worked for me through difficult times, but am I positioned right as we move forward? And if you have that conversation, what it does is it allows you to accomplish step 4 on this roadmap, and that is to have some confidence in where you're going, because we're not telling you how to invest, not telling you exactly where your money should be in this conversation, but we do know over the long run that we need to have exposure to the markets in order to see your accounts grow. So in closing, we want to invite you to spend some more time with us. We have a number of additional educational opportunities coming up. A couple of these are very retirement plan related. Whatever role you might have in a retirement plan, whether you're a participant in one, you're a plan sponsor, you're in HR, you're a CFO, you're a business owner, we have some opportunities to learn a little bit more about legal developments here in Fiduciary 15 on April 18th. We have our firm's national event, the Qualified Plan Fiduciary Summit, later in April. And then for anybody out there who's interested in additional financial wellness education, we have a webinar at the end of the month. And we'd love to see any and all of you at any of those events. So again, thank you to Scott, to Marilu, to Eric. We really appreciate it. I always learn so much, in the work we do to prepare for these and then in the execution. So I want to personally thank you for your time and your expertise. And if anybody has any questions, I hope you'll reach out. We'd love to have the conversation. We hope you have a great rest of your afternoon. Thanks so much.